going to get much worse. I'm listening closely. Economy's going to get much worse. But yet the leading indicators, or some of them like real estate or discretionary consumer tech, are down 40 to 80% already. Is it possible we could form a bottom either here or shortly, notwithstanding a bottom in the markets, notwithstanding further economic deterioration?
Yeah, the one piece we haven't talked about is multiples. So if you look at the S&P multiple, when you've had CPI above 5%, and obviously it's above 8% right now, the multiple for the S&P 500 on a trailing basis is 12 times. Right now it's at 18.4 times. So to get to that multiple, the market would need to go down another 30+%. If you want to be wildly optimistic and assume you get down to a 3% CPI, during that period, you've got market multiples at 15 times. So that means the S&P would have to go down another high teens. That's just to get to average. You never really get to average during bear markets. They always tend to overshoot on the downside. So I think it's really hard, especially sitting in front of a horrible earnings season, which is about to occur. Don't forget, Target went down the most in a day since Black Monday in 1987 when they gave you guidance. For the March quarter. Walmart, the most since 1987 Black Monday when they gave guidance. So you're not seeing a whole lot of signs that stocks or people are doing the usual, oh, well, this is the bottom and I really have to buy. And the main reason is the Fed is your enemy for the first time, you could argue, in 40 years, and not your friend, because they can't step in to stop the carnage because they have to deal with inflation first.
Hey, Dan, this all makes sense, but every person we've talked today has been pretty pessimistic. I think Mike Wilson is the most optimistic, and he still says there's a chance that if we go into recession, there's 50-50 chance that we end up 30% lower. When you have everybody convinced that stocks have to go a lot lower, sometimes there's some counterintuitiveness that comes into this. Maybe, is there a chance we bounce for a while? And you just think that even if we do, it's not going to be something that lasts?
Yeah, so, I mean, we think there's a bounce coming. So if you look at our Twitter post on Friday, we said, over 40% of our indicators, I think we said 44% are oversold. We're positioned for the next bear market rally. And if you look at bear market rallies, so you take the global financial crisis or the tech bubble, the S&P went down 50% both times. But you had 5 separate rallies in the S&P 500 of 18 to 21% while losing half your money from peak to trough. So could you have a vicious bear market rally? Yes, because you've seen that before in some of the worst bear markets that we've ever seen. So for us, it doesn't really matter. We're positioned for a big bounce, but much like you've seen this year with our posts, our feeling is you run it up just like you always do, because people think, oh, it's all discounted and they're down so much, how could they go down more? But there's a time component to this that people are forgetting, which is normal bear markets or recessions, they're lasting 1.5 to 2 years. The market peaked in January, we're less than 6 months into this. So that element of it still hasn't played out where we figured out where the fundamental bottom is, that then you can apply a multiple to that makes sense to figure it out. In the short term, I don't care if this is the bottom or a bear market bottom, because I'm positioned the same way. I'm very long. We've covered most of our shorts. As the fundamental data plays out, then we'll figure out, okay, do we go short again, or is up 10%? Are we going to continue because all of a sudden inflation's dropped more than we thought? We have a ceasefire with Russia. China forgets about locking down their cities, and the fundamental data all starts to improve. That could happen, but I sincerely doubt it.
You said you're very long. You like other things besides Chinese stocks? What else?
Yeah, so for us, the way we get long is we cover a lot of our shorts. So you have to remember, at one point we were, and I know you said this on air, but we were short over 20%. Right now, if you subtract the percentage of our portfolio that's long minus the percentage of our portfolio that's short, we're up over 50% long, which for us is pretty aggressive, because on average, over 18 years, we're long about 25% now. So beyond just Chinese tech, what we happen to own is a lot of the reopening names. So hotels, Airbnb, Hyatt, services that people are switching to, Uber, as the economy switches from goods, which you bought during the pandemic because you had nothing else to do, to services, and we all get out and travel. And so we're focused on those areas as a big one for one, China tech for another, and then some of the internet names where we think, you know what, maybe, you know, like with Facebook, disaster this year, but we bought it back quite a bit lower and go, you know what, maybe at 14 times, you know, this is an area where it makes sense with the S&P, you know, quite a bit higher than that in the high teens. But that's how we're kind of playing things right now.
Dan, thank you. Always good to see you.
Thank you, Becky.